Guys, I want to thank everybody for joining us for this week's episode of Penny Insurance's educational seminars. Today, we're going to go over mitigating taxes before you cash in six figures of income. I am going to jump in and kind of talk about a little bit of what Penny does and how we can help your practice. So, without any further ado, we'll kind of move on. So what we do at Penny is we provide administration, application processing, follow-up, and underwriting coordination every step of the way from A to Z. We can help cover with your insurance firm. And the reason why we built the Penny A team, life insurance opportunities rarely disappear because clients lack interest or because solutions aren't appropriate. More often, strong cases slow down or fall apart due to the operational demands required to move them from conversation to placement. Gathering client information, completing applications, managing requirements, coordinating underwriting, and maintaining follow-up can quickly become very overwhelming. Even highly successful producers often find themselves pulled away from revenue generating activities just to keep cases moving forward. When follow-up becomes inconsistent or timelines stretch too long, momentum can fade. Clients become distracted, decisions are delayed, and opportunities that should have resulted in placed business are lost due to process rather than actual strategy. The solution is the Penny A team. The Penny A team is a dedicated group of specialists designed to function as an operational extension of your practice. Once you identify an opportunity and make a warm introduction, the A team helps manage the implementation process from start to finish. This includes guiding the client through the application process, coordinating underwriting, and supporting the path to policy approval and delivery. And how the A team supports your business. We assist you with helping lead the client conversations when needed to ensure clarity and professionalism. Manage application completion and documentation requirements to reduce administrative burden. Coordinate with carriers and underwriting teams through an experienced case management group with over 45 years of combined experience. Track requirements, monitor progress, and maintain consistent communication throughout the underwriting process. We also proactively follow up and keep cases moving forward towards approval and placement. What does this mean to you guys as the agents? You'll spend less time managing paperwork, requirements, and carrier communication. You'll be able to stay focused on the highest value activities, building relationships, advising clients, and identifying new opportunities. We'll maintain full ownership of the client relationship while the operational team works behind the scenes, improve case momentum, placement rates, and overall client experience, and scale production without hiring additional internal staff or increasing operational complexity. The goal, we're going to help agents place more business, create a smoother experience for clients, and enable advisors to scale their practice efficiently and sustainably. Guys, here's some testimonials from some people we've worked with in the past, very recently. Here's one from Mr. Thaw, and another one from Cyrus. Cyrus has been a great mouthpiece for some of the work we've done. Moving on, I will give you a little bit of a disclosure. This material is provided for educational and informational purposes only and is not intended as and should not be relied upon as tax, legal, or financial advice. You should consult with your qualified tax advisor, attorney, or financial professional regarding your specific situation before making any decisions. And the strategies discussed may not be suitable for everyone and are subject to change based on laws, regulations, and individual circumstances. So, guys, today we're talking about advanced exit planning for business owners. What we're doing here, we're either going to be turning a business sale into a long-term wealth strategy. And most business owners, often about 70 and 90% of their wealth, are tied to their actual company. They're anticipating a liquidity event that creates a major planning opportunity. And the goals here are to reduce taxes, create income, diversify wealth, and plan a legacy. And we're going to go over a few things, a couple examples but we'll also briefly touch on a couple of the different vehicles that can be used as well. So the tax impact of a business sale. Let's say an example business sale, $10 million. They're going to be looking at federal capital gains taxes of 20% or more. Their net investment income is taxed at 3.8%. And then depending on what state they're residing in, their state taxes can be anywhere from 0 to 13%, depending. Potential total tax burden could be anywhere from 2.3 million to 3.5 million plus. And this is something we want to help mitigate for our business owners that are looking to do succession or exit planning. So the exit planning opportunity window. We don't want to talk to people after the fact. We want to get in front of them anywhere from 6 to 8 months, maybe even a year before, depending on the complexities. Most of the best planning is going to occur before the sale closes. And some of these key strategies may include installment sales, charitable planning or CRTs, qualified small business stock transfers, QSBS, opportunity zone investments, and insurance-based wealth strategies, which is really our sweet spot here at Penny. So the first one, and we'll briefly cover this, would be a charitable remainder trust strategy. These contribute appreciated business interest or assets into the CRT. The CRT can sell assets without immediate capital gains tax. The owner receives a lifetime income stream, and the charity receives the remainder at the death of the owner. It provides charitable deduction and an opportunity to diversify. Another one that we use in conjunction with CRTs would be wealth replacement with life insurance. And that's going to be a CRT that reduces estate value passed on to the heirs. Life insurance can replace that wealth by giving them the ability to take those assets in a wash loan tax-free. The CRT income can fund insurance premiums, and then insurance owned by an irrevocable life insurance trust can also be utilized to defer taxes or to get that money out of their personal tax identification number and put into a trust with compressed brackets so that they don't realize a full 40% estate tax. And this creates a tax-free death benefit transfer for any heirs. An integrated example of this would be, let's say we have a business sale of about 8 million. 3 million plus would be diversified in an investment portfolio. 2 million would go into a charitable remainder trust or CRT. And the CRT income could be used to fund life insurance premiums inside of the irrevocable life insurance trust. The outcome of that would be both income, tax mitigation, and legacy planning to pass the business interest or the liquidity on to heirs without creating an unnecessary tax burden. So some of the core objectives for exit planning. We want to turn taxable liquidity events into a tax-efficient income stream. We want to protect and leverage the capital. And then we want to optimize that wealth transfer from an estate tax standpoint. Anything over those thresholds are often going to result in a federal 40% estate tax. And that's what we want to help business owners avoid. One of the key ones that we can use here would be a Section 409A, and that's going to be a non-qualified deferred compensation plan. Basically what you're looking to do is defer a portion of compensation before the sale, pay it out over a 5 to 10 years post-sale, and it will reduce income in high tax sale year, smooths out the income into lower brackets going forward. And it can be used in conjunction quite nicely with corporate-owned life insurance to informally fund it. The second one is, like mentioned in the aforementioned, but corporate-owned life insurance. It's a powerful balance sheet asset pre-sale. The business buys life insurance on key owners and builds a tax-deferred cash value that could be included in the assets or the P&L. The benefits of this is it offsets deferred comp liabilities. It creates a tax advantage liquidity bucket and improves balance sheet optics for those that are looking to acquire that business. Third one is an executive bonus plan or a 162. So under Section 162, a bonus key employee or an owner pre-sale could use that bonus to fund life insurance. What this would do would give an immediate tax deduction, retention of the tool pre-sale, so they can pick whether it's owner owned or if it's business owned, and then creates a personal asset outside of the business if it's not business owned. It's also a great way to retain key employees and reward them for 5, 10, 15 years of loyalty to the company doing good work. Another great one, and this is one that's widely used by medium to even larger size companies, is split dollar life insurance. They're great for larger exits, usually 5 million and above. And the strategy here is a company and owner would share policy benefits and build cash value within it, and then structure it as a loan or an endorsement. So they would either gift it to the employee, or the employee could use the cash value inside for some liquidity in the form of a wash loan, in which they could get that money and get at it tax-free. The benefits of it's really going to leverage dollars more tax efficiently. It shifts the value out of the estate of the owner, and also out of the recipient, and then it's minimal current tax cost if structured correctly. And then finally, we have another one. This is something that's kind of grown a little bit more popular in the last few years, is an intentionally defective grantor trust. This moves the future appreciation out of the estate. One could sell minority shares to the IDGT pre-sale. It freezes the cost basis or the estate value and allows future upside to escape estate tax. Income tax paid by the grantor will actually be covered, and then it will provide more wealth to transfer over to the recipient or the heirs. And then we also have another one. This is more kind of on the lines of what we call a supplemental employee retirement plan, or SERP, which a lot of you are familiar with. It would be a cash balance plan or a 401k plan. It's massive pre-sale deductions. You can max out your contributions in 2 to 3 years pre-sale, and typically can shelter up to 100K to 300K plus a year, depending on your personal tax bracket. And it reduces taxable income leading into the sale. And then finally, we'll reiterate on the CRTs, or the charitable remainder trust. These are pre-sale only instruments. So we need to really get to you, at minimum, roughly 8 months before you see a large windfall. It'll transfer a portion of business interest into that charitable remainder trust. The CRT will sell tax-free. And then the benefits of this is it defers capital gains, creates a lifetime income stream, and also provides a charitable deduction. Another one we've seen that is very, very popular over the last 4 or 5 years that we're seeing larger firms look at is deferred sales trusts. This is a hybrid structure using installment sale concepts. Most of what you're going to do is you're going to sell those assets to a trust. The trust sells that to the buyer, and the owner receives payments over time systematically, lowering what they would receive in whole, allowing it to take it systematically and reduce the taxes. The benefits of this is it's going to defer the capital gains. It creates a flexible income stream that the recipient can control within their tax bracket, but it must be properly structured. You usually are going to want to have a tax attorney and a CPA kind of helping you quarterback this, and we're more than happy to kind of show you the outlines of it. Another one is running a pre-sale bonus and insurance arbitrage, which is a fairly underrated strategy. It issues a large bonus that is deductible. It uses after-tax dollars to fund life insurance, and it creates a tax-advantaged growth bucket as well as future tax-free access that you can use via a wash loan with a permanent policy. So essentially the step for this is going to be, one, you're going to position the asset before the sale. How it's structured or where it sits matters. That's going to be a part of the strategy. We're going to move excess cash off of the balance sheet, and we'll fund either insurance vehicles, qualified plans such as a SEP plan or a simple or a 401k or any other employee, even group plans can be used, and then they'll be used in conjunction with trusts. The reason why we do this is it creates clean business financials, and it prevents double taxation on trapped cash within the entity. So some key takeaways here, and just to speak simply on it, would reduce taxes from the liquidity event. It'll convert business equity into sustainable retirement income for the recipient. It protects wealth and transfers assets efficiently. And in the form of CRT, it creates a philanthropic or family legacy. And then you would always want to coordinate these, planning initiatives with a financial advisor, a CPA, and/or attorney. So these are the pillars of what we're handling now here at Penny Insurance and at InZone. So we're looking at group, personal lines and commercial lines, retirement solutions, long-term and short-term disability, annuities, life insurance, and health insurance. We're basically building a scope to where we can handle everything from A to Z and help you guys structure these things intelligently. So the moment that changes everything, a massive liquidity event. So let's say you know that you're going to get a large windfall in a year, 8 months, 6 months. You've probably spent years, half a lifetime building that equity in a business, a real estate portfolio, or an investment portfolio, and eventually that equity is going to become cash. Well, as soon as you realize that cash, the IRS is going to be on your back looking to get their portion. A lot of what we're doing here is we want to make sure that if you're going to do a legacy transfer, or you're going to push money over to a partner as you exit, we want to make sure you're not making the IRS your biggest beneficiary. There's not many guarantees I have in this business, but I can say that we do believe firmly that you will spend that money, or your heirs will spend that money better than the IRS will. So the tax shocks most clients don't expect is when equity converts to cash. It will trigger capital gains taxes. The timing of when you do it and what your tax bracket is at, it matters more than most people realize. And if that planning often happens too late, if you've already realized that windfall, it's often too late to take care of any taxes in year one. Now, we can still help you mitigate years, 2 through 5 through 10, 15, however you want to structure that out. It's not too late to help you moving forward, but often you are going to take that big tax hit in year one. So a large portion of that gain can be lost to taxes, and that's what we're trying to help people mitigate here. So this is more than a transaction. A lot of this is somebody's put their entire life into a business. And when we as advisors can engage early, we can deliver significantly more value, expand the relationship, and leverage more opportunities to do business and develop credibility with our clients who've maybe only done personal lines or commercial with us. And it also allows us to participate in much larger cases where they would normally be seeking out, third-party specialists. We like to keep that within the InZone family instead of sending them out to a third party that may not value that relationship as much as we do. Why taxes get so high? Well, number one, capital gains. Let's say you have a large windfall within a single year. Your short-term capital gains are going to be considerably higher than your long-term capital gains. So that's one thing we want you to think about. We also, for those that have large real estate portfolios, we want to allow them to get some of that depreciation recapture. We want you to think about your resident state income taxes and then your net investment income tax as well. There are multiple layers of taxation, and they can stack quickly. What you may have thought or calculated on your federal incomes bracket could be a very surprising term when you look at things such as alternative minimum tax, net investment income tax, and state taxes. And we don't want anybody to get a big surprise at a time when they need the liquidity or need a business continuity plan. So introducing this conversation to your people, it's kind of forms off of, hey, we've got a guy, we've got people here that are specialists that can help guide you through this. The simple positioning is what's going to happen after the sale may matter just as much as the sale itself. A lot of people don't understand, what's going to happen after this windfall. Well, you're going to get exposed to taxes, and often there's going to be a large amount of planning to keep as much money as possible. So what we're focused on is preserving wealth, reducing unnecessary tax exposure, and creating, beneficial scenarios that make for better long-term outcomes for our business owners. Planning before the event. We're going to evaluate the ownership structures, what your entities are, whether you're an S Corp, a C Corp, LLC, GP, or LP. Any of these different business structures will come into play. We're going to explore tax-efficient repositioning of these strategies, and then we'll coordinate with CPAs and tax attorneys as well as drafting attorneys to help coordinate that plan in a fashion that mitigates all of these taxes. And then we will identify those opportunities within the time scope of when the work needs to get done and when the windfall will be realized. So repositioning the proceeds, key considerations, like we said ad nauseum, tax efficiency, income generation, risk management, and legacy planning. And turning these transactions into a strategy, any large liquidity event can lead to a larger planning conversation. We want to be able to have those conversations with you guys. Multi-product strategies and cross-sell opportunities with your business owners, and creating a leveraged relationship for a long-term, client relationship. We want to make sure that, if they were doing other forms of business with us, we'd like to deepen those relationships and have you be able to be kind of a turnkey solution for these people. The long-term impact of that is these clients are going to be able to preserve more of what they've built or spent their formative years working towards. It's going to improve their long-term financial outcomes and support legacy and wealth transfer goals. And the ideal client profiles for this are mostly going to be business owners preparing for exit. Like I said, usually, if it's terribly complex, we might want to catch them 18 to 24 months before, or, a year before, but, at minimum 8 to 6 months before. Real estate investors are a great opportunity to implement some of this planning. Entrepreneurs with concentrated equity, or let's say they have restricted stock units or equity that they own in the form of a employee stock option plan, they're going to be able to realize things, strategies such as net unrealized assets, where they can get the original cost basis and not get taxed on how much it's grown over the last 10 or 20 years. And we can bring in tax specialists that'll help us with the tax lot so you can efficiently take that. And the clients with highly appreciated assets, let's say they bought a property for $8,000 in a foreclosure sale and ended up doing a lot of building onto it or added to the value of that, and it's significantly more than what the original cost basis was. They should run to us so that we can help them develop a strategy to where they don't realize the full appreciated tax burden. Another one, as this kind of goes forward, you're going to be a trusted advisor positioning these things. You're going to become somebody that is a strategic planner, not just transactional. Maybe they did a few things with you that were pretty much one and done. This puts you in the driver's seat for continued relationships. Being a part of that pre-sale planning conversation is going to be crucial to them mapping out what their estate's going to look like, or what those proceeds are going to look like for their family. And it makes you a long-term partner in that wealth strategy. And that's the relationship that we're looking for. That value is something where you can provide a service to somebody for a lifetime, and it makes for stickier client relationships, and it puts you with the credibility of a trusted advocate. So your ideal client profiles, obviously, we kind of went over some of these. Only key takeaways. What we're trying to do is create liquidity events that we can mitigate that tax exposure. The planning must happen before the event, or some of the benefits would be mitigated. And like you said, if you've already realized that windfall, there's still stuff we can do for years 2 through moving forward, but it's kind of hard to take care of the initial event. So we want to get to you early, talk to you about that structure, and make a plan. Those early conversations are going to unlock most of the value. And we're talking probably a ratio of 70-30. If we get to you before the windfall, we can provide you with 100% of a benefit. Once you realize that windfall, it's probably mitigated by anywhere from 65 to 70%. And this is a gateway to larger premium cases that can boost your revenue on balance sheet. Once again, ad nauseum, we want to start that conversation as early as possible. So if you can identify clients who may have an upcoming exit, highly appreciated assets, or a future liquidity event, let's start this discussion before it happens and give them a map and a roadway to success before those windfalls happen. And how do we support these conversations? One of them is right here, providing some education on advanced market guidance. We'll come in and provide case design support. I head that up here at Penny. And then the planning, collaboration, and carrier strategy alignment is done with our A team and our brokerage directors right here at Penny Insurance. And for those who might have further questions, some of this stuff can get very complex. I do like to have these conversations personally with our team and our strategists in place. I am going to give you my personal contact information. If you have anything that is kind of mirroring what we've talked about today, we'd love to engage in a conversation and see if we can head some of that stuff off before you get exposed to a high tax bracket. And once again, I'm backed by the Penny A team, Keelan Johnson of our brokerage support, and a great team here. We basically handle all of this stuff as a team. And though I might kind of be the figurehead of it, I don't do any of this stuff by myself. We bring in, if you don't have a personal attorney or a CPA, we're happy to throw you some referrals, but we are going to engage in with the proper people that come and help us do it right, such as a tax attorney, a tenured CPA that's done stuff like this before, as well as myself, who is a financial advisor and has headed the initiative towards some of this stuff. So guys, I would be happy to take on, a couple of questions, probably not specifically on section 162s or 409As, but I would be happy to take on some questions on how to identify the clients that would utilize this kind of stuff. If anybody has anything that they'd like to add.
Looks like for now, there are no questions. Do you have any closing thoughts, Charles?
Closing thoughts, really the big thing, the cornerstone of this is if you have people that are talking to you about taxes and they want to know what is their tax exposure going to be, what do brackets look like, or they have worries about future taxes, you're talking to the right people. You're in the right place. Those are going to have large liquidity events that want to be able to keep more of their money. If they can get to us now, we can come in and make a very big difference moving forward for them.
So thanks for joining us, everyone. This is part of our educational webinar series. So we're doing webinars every Thursday at 12 p.m. PST. More than welcome to join us. We'd love to have you. And thank you so much for joining us today.
Thank you, everybody, for joining us. Appreciate you logging on, and we will have more material coming up every week.